The broadcast is now starting. All attendees are in.
To begin, please take note of our disclaimer. The agenda for this webinar will be as follows: recommendation, nature of business, financial review, divisions, company guidance, and lastly, portfolio guidance. To move on to the recommendation, we recommend an exposure of up to 3.63%. FirstRand is a premier financial services provider with a strong diversified portfolio of businesses whereby diversification strategies should support growth over the longer term. With a good case for cross-selling opportunities in the distribution of F&B, despite the muted economic environment. We anticipate the strong momentum in its operations to be maintained and be transferred into new segments, such as their investment management operations. However, the short-term conditions will be a challenge for the group, specifically in the lending franchise, which accounts for more than half of the group's income. Thus, Africa and the transactional business, where the resilience of non-interest revenue was reflected despite pricing actions to protect share and lower income, will become increasingly important components of growth. In addition, customer acquisitions is robust and the e-migration has occurred faster than expected. FirstRand has a good track record of providing innovative digital solutions for its clients, which should help support the resiliency of its transactional business. Credit costs have deteriorated slightly but are still low. However, the more conservative approach in riskier segments, especially in the vehicles and unsecured space, should stabilize these costs. It is important to point out that the impairment ratio is still below the group's through-the-cycle threshold. The lower interest rate environment will have a negative impact on endowment going forward, but some relief on consumers should translate into credit affordability and higher transactional activity on the back of higher discretionary spend. Trading on a forward PE of below 12 times and 2.8 times its net asset value, we feel the quality premium is reflected in the share price and is trading at a substantial premium to SA banks. We feel that the share is fairly valued at current levels. The share also offers an attractive historic dividend yield of 4.7%. To move on to the nature of business, FirstRand provides a comprehensive range of products and services to the South African market and niche products in certain African and international markets. The group is differentiated by its product portfolio branding approach, and there are a number of leading financial services franchises within the group, such as Rand Merchant Bank, First National Bank, and West Bank. To move on to the financial review. Real growth and top-line performance despite a challenging operating environment. Net interest income increased 5% to 38.6 billion rand, supported by a 7% increase in deposits and a positive endowment effect from higher domestic interest rates. Despite the positive endowment and a more favorable funding mix, the net interest margin came in slightly lower at 5.26% due to higher liquidity costs and asset pricing. Advances growth decelerated to 5%, but is in line with the group's appropriate risk appetite. Term lending in West Bank and RMB's corporate businesses remains subdued due to a discipline in origination to preserve returns given the prevailing competitive pressures. Net interest income was slightly offset by the provision for bad debts, which increased 13% to 8.1 billion rand, containing the increase in income from lending activities to 5%. Retail provisions were increased on a franchise level due to the group's current view on macroeconomic environment. On the other hand, corporate provisions decreased due to the rehabilitation or written off large corporate exposures, thus reducing their impact to the group's overall portfolio provisions. The overall portfolio provisions of 95 basis points are above the credit loss ratio of 91 basis points. The credit loss ratio remains below the group's 100 to 110 basis point target range. Non-interest revenue increased 8% to 39.3 billion rand on the back of a 7% increase in commissions and fees at F&B, which constitutes 78% of the group's operational non-interest revenue, and was supported by volumes in digital and electronic channels, as well as growth in the customer base. This was despite the negative impact, simplification and pricing adjustments taken in the lower income commission income and fees area. Realizations in RMB's private equity portfolio further aided non-interest revenue. Insurance revenues saw a significant increase of 26%, supported by 11% growth in Westbank's insurance income and volume growth in credit and funeral products at F&B. Operating expenses ticked up to 43.8 billion rand, which was an increase of 7%. The increase is tracking ahead of inflation due to investment in building the footprint into the rest of Africa, the newer asset management and insurance franchises, and platforms to gain further efficiencies. Operating jaws was positive for the period, with a marginally unchanged cost-to-income ratio of 51%. Normalized earnings per share was 7% higher to 436.4 cents. A gross final dividend of 136 cents was declared, reflecting a 15% increase to the prior period. This brought the total dividend for the year 13% higher, being ahead of the 7% increase in earnings growth, and therefore reducing dividend cover below the group's target range of 1.8 to 2.2 times. Given the group's strong capital position, together with expectations of slower risk-weighted asset growth in the current environment, management believes that the dividend cover can be maintained below the target over the short to medium term. Reported return on equity decreased marginally to 23.4%. Normalized net asset value was up 9% to 1,942 cents. To move on to divisions. F&B contributed 53% to normalized earnings. Net interest income increased 9% on the back of 12% growth to 45.5 billion rand in deposits, where retail was up 14% to 24.6 billion rand, aided by a 16% increase in premium to 16.8 billion rand, and commercial was up 12% to 20.9 billion rand. Net interest income was also aided by 5% growth to 15.8 billion rand in advances, where retail was up 4% to 8.9 billion rand, commercial was up 7% to 5.6 billion rand, while F&B Africa was up 3% to 1.3 billion rand. Advances were contained by a high level of prudency, especially in the unsecured consumer segment, where disposable income is under pressure. Cross-selling into premium retail and commercial customer bases resulted in good growth in deposits and advances. Net interest income was further aided by positive endowment, owing to higher average interest rates. The credit loss ratio rose to 1.2%. Non-interest revenue growth of 6% was achieved, supported by retail and commercial segments, increasing 6% and 9% respectively, reflecting the group's digitalization strategy and good customer acquisitions. The consumer segment saw a 540 million rand negative impact to non-interest revenue due to F&B simplifying its product offering and reducing pricing. The cost-to-income ratio remained relatively stable at 54%, with expense growth kept to 6% in South Africa, offsetting continued investment into the African subsidiaries. Ultimately, normalized profit before tax rose 5%, reflecting an 8% increase in the domestic business and 32% decline in the rest of Africa. The division achieved a return on equity of 37.4%. Within the transactional franchise, normalized profit before tax was up 8% and contributes 65% of F&B's profit before tax. Consumer transactional profit before tax weakened 19%, owing to product simplification and fee reductions. Premium and commercial transactional profit before tax strengthened 35% and 13% respectively, where good traction has been made in upsell and cross-sell opportunities. Overall, the division benefited from a positive endowment effect, 10% growth in volumes, and positive customer growth of 3% in consumer, 7% in premium, and 11% in commercial. Sustained e-migration to cheaper channels has benefited the transactional franchise. However, a short-term revenue squeeze has been the result, owing to the e-migration being faster than expected. This has caused a shift in branch activity from service to sales. In term lending, normalized profit before tax was up 13%, where focus remains on own customer base through cross-sell strategies. The commercial segment benefited from client acquisition and targeted product penetration. The retail segment showed good growth from premium and pullbacks in consumer high-risk buckets in the unsecured space, while mortgages maintained a conservative approach. Overall, impairments remain in line with expectations. In Save and Invest, normalized profit before tax was up 13%, whereby product innovation has supported growth. Good growth in deposits was noted due to client acquisition strategies paying off. This is in addition to digital channels gaining further traction. In insurance, normalized profit before tax was up 13%, supported by good traction in funeral policies within the consumer space, as well as sustained cross-sell opportunities leveraging off the existing client base. Costs increase on the back of higher investment-related costs due to a new license and platform renewal. In addition, acquisition costs increased with volume growth. Life embedded value jumped by 48% to 3.5 billion rand. In the rest of Africa, normalized profit before tax was down 32% to 880 million rand. Earnings from the more mature territories remain stable, negatively impacted by some regulatory changes. The loss from the emerging and startup business increased by 58%, in part due to the combination of challenging macros and ongoing investments. To move on to RMB, this contributed 28% to normalized earnings. Normalized profit before tax increased 10% to 9.8 billion rand, aided by an increase of 29% in pre-tax profits from the rest of Africa of 1.3 billion rand. Performance in the rest of Africa was supported by robust transactional and corporate banking earnings, as well as flow trading and structuring income. In addition, advances growth and lower credit impairments further weighed positively to the performance. The rest of Africa remains a key focus to RMB strategy. Normalized profit before tax in South Africa was up 8% to 8.5 billion rand. Overall, the credit loss ratio narrowed to 0.2 from 0.27, with non-performing loans also dropping significantly from 1.35% to 0.62%. Cost-to-income ratio reduced to 43.4%, while the return on equity improved to 26.2%. In the investment banking and advisory activities, normalized profit before tax increased 11% to 3.63 billion rand, where fee income was aided by key lending and underwriting mandates. Good advances growth was offset by continued margin compression. A strong portfolio coverage ratio was maintained. In corporate and transactional banking, normalized profit before tax was up 18% to 1.73 billion rand, where robust operating draws were noted due to investment in platforms. Strong demand came from structured and traditional trade products. On the back of certain regulatory environments, global foreign exchange was negatively affected. In the rest of Africa, the liability raising strategy gained traction. Within marketing and structuring activities, normalized profit before tax was up 16% to 1.61 billion rand, supported by an improved quality of earnings across asset classes, where good performance in commodities and sustained equity flow were reported. In addition, balanced performances across fixed income and foreign exchange were reflected. Notable structuring deals were concluded for the period. In investing activities, normalized profit before tax increased 7% to 2.84 billion rand, owing to strong annuity earnings as well as good realizations. New acquisitions aided towards replenishment of diversified portfolio, which is now in the investment cycle. The unrealized portfolio reduced somewhat to 3.7 billion rand. In investment management activities, normalized profit before tax decreased 50% to 88 million rand. Moving on to Westbank, contributed 16% to normalized earnings. Normalized profit before tax was 2% stronger to 5.6 billion rand, despite the tough operating environment for the domestic lending businesses, where increased conservatism in origination and provisioning were noted. The 20% average appreciation of the rand against the pound had a significant impact on Motonovo. Non-interest revenue was up strongly by 15%, driven by strong growth in insurance income, value-added services, and rental income. Overall, the credit loss ratio ticked up slightly to 1.68%, while non-performing loans ratio saw a similar picture, up to 3.8% from 3.38%. The cost-to-income ratio was marginally up to 40.2%. The return on equity came in at 20%, down from 21.9% in the prior period, due to additional capital for new investments and higher risk-weighted assets from a more challenging credit environment. In local VAF, normalized profit before tax increased 13%, or 6% on an organic basis, excluding the Motor Vantage acquisition. Normalized book growth increased 10%, accounting for the rundown of business, which is now written in associates. Profitability in associates saw a significant improvement. New business production growth improved to 9.7% from 5.8% in 2016. Impairments normalized given the credit cycle and are within expectations. Strong cost containment was noted. In Motor Novo, normalized profit before tax increased 9% in constant currency terms despite investments. Rand-based normalized profit before tax weakened 13%, impacted negatively by exchange rate movements. Risk appetite tightening impacted origination, resulting in advances growth in pounds increasing 23% and new business production of positive 12%. The impairment charge improved in the second half on the back of collection efforts and cutbacks in high-risk buckets. In corporate and commercial, normalized profit before tax weakened 10%, owing to a declining asset-based finance book characterized by suppressed demand and credit appetite. A suppressed dealer funding portfolio was the result of muted new vehicle sales. Also highlighted was a sustained investment drag in the full maintenance leasing business. In personal loans, normalized profit before tax increased 2%, supported by new business production, which was up 18%, and advances progressing by 14%. This was offset by NCAA rate caps impacting volumes and margins. In addition, sustained risk appetite and cost drag from investment in new marketing initiative weighed on performance. In the rest of Africa, normalized profit before tax decreased 25% to 68 million rand. Other contributed 2% to normalized earnings. Normalized profit before tax was higher at 573 million rand. Let's move on to company guidance. Management remains concerned about South Africa's growth prospects, which are expected to remain weak and uncertain. The political and policy uncertainty and ongoing governance issues as state-owned enterprises is expected to erode confidence and undermine private sector investment, which will have a knock-on effect on GDP growth. Ultimately, top-line growth in the group's domestic franchises is expected to be impacted negatively. Growth rates in sub-Saharan Africa are expected to show a recovery over the next 12 months, which should support the group's rest of Africa portfolio. The group aims to achieve an ROE near the upper end of the targeted range of 18 to 22%. In addition, the group remains committed to its current investment cycle, where outperformance over the medium to long term will be supported by the group's strategy to diversify its financial services offerings and to build the UK and rest of Africa franchises. Controlling core costs and driving efficiencies remains a focus for management. To move on to portfolio guidance. FirstRand has a capped SWIX all-share weighting of 3.46%. A neutral guidance. Recommended exposure of up to 3.63%. In closing, if you'd like to place a trade, please contact our trading desk. In addition, should you have any questions, please use the comment section now, and we'll get back to you via email. That brings us to the end of this webinar. Thank you for attending.